If you have ever looked at the market and thought price is moving randomly, this video will completely change the way you see charts. Because what you're about to see is not randomness, it is intention, it is planning, and it is smart money leaving very clear footprints on the chart. Welcome back. In this video, I'm going to walk you step by step through a real market example and show you how smart money builds a move where most traders get trapped, and how price is engineered from the left side of the chart all the way to the final expansion. By the end of this video, you will understand market structure, break of structure, order blocks, market structure shift, inducement, sell-side liquidity, and how all of these pieces connect into one logical story. If you find value in this kind of content, make sure to subscribe, because every video builds on the previous one and helps you see the market with more clarity. Now let's start from the left side of the chart, because everything begins there. On the left side, the market is clearly bearish. We are forming lower highs and lower lows, which tells us that sellers are in control. Price is respecting bearish structure, and every pullback is being sold aggressively. At this point, something very important happens. We see a strong bearish candle that breaks the previous structure decisively. This is not a weak break. This is not a slow grind. This is a powerful displacement candle showing strong participation from institutional players. This break of structure is important because it confirms continuation of the bearish trend. It tells us that smart money is still active on the sell side and that price is not ready to reverse yet. Retail traders often miss this and start looking for buys too early, but structure is very clear here. After this break of structure, price continues lower, but eventually we see price pull back upward. This pullback is where many traders get emotional and confused. They think the market is reversing, but smart money thinks very differently. Now pay attention to where price pulls back into. Price returns into a clearly defined order block. This order block is formed from the last bullish candles before the strong bearish move. This is where institutions previously placed large sell orders. And because the move away from this area was aggressive, we know this zone holds unfilled orders. This order block is located in a premium area of the range. That alone is already a warning sign. When price trades back into premium during a bearish market, smart money is not looking to buy. They are looking to sell at a better price. So when price reaches this order block, we are not entering blindly. We are observing. We are asking one question. Is the market reacting the way smart money would want it to? Inside the order block, price slows down, momentum decreases, wicks appear. This tells us that sell orders are being absorbed and executed. Now let's talk about market structure shift, because this is where many traders make mistakes. As price moves away from the order block, we see a short-term bullish push. Some traders immediately assume the trend has changed, but this is not a full trend reversal. This is a market structure shift on a lower time frame. A market structure shift does not mean the higher time frame trend has reversed. It only tells us that price is making a temporary correction or manipulation. Smart money often creates these shifts to trap traders into early entries. So what caused this structure shift? Liquidity. Price needed liquidity to continue lower, and liquidity is created by convincing traders that the market is going to reverse. This brings us to the major inducement. The major inducement is the area where smart money encourages traders to enter in the wrong direction. Price moves just enough to break short-term highs, triggering buy stops and attracting breakout traders. At the same time, sellers hesitate and close their positions. This creates a pool of liquidity, and liquidity is fuel. Now notice how this inducement aligns perfectly with the order block. This is not coincidence. This is confluence. Smart money sells into the inducement while retail traders are buying. Large players use the liquidity created by retail orders to fill their own positions efficiently. After inducement is complete, price is ready to move. Now let's talk about sell-side liquidity. Sell-side liquidity is resting below obvious lows. These are the stops of traders who bought too early or placed their stop losses in predictable locations. Price needs to reach this sell-side liquidity to complete the algorithm. Markets do not move without a reason, and that reason is almost always liquidity. Once enough liquidity is built above, price is free to move lower. And when it moves fast. Now let's recap what has happened so far. We started with a bearish market structure. We saw a strong break of structure confirming trend continuation. Price pulled back into a premium order block. A short-term market structure shift occurred to create confusion. Major inducement formed to trap buyers. Liquidity was built on both sides. Now it is time for execution. Entry is taken after inducement is clearly completed and price shows rejection from the order block. We do not enter randomly. We wait for confirmation that smart money has finished distributing positions. Stop loss is placed above the order block. This is critical. If price breaks and holds above the order block, our idea is invalid. A proper stop loss protects capital and keeps us disciplined. Target is placed at sell side liquidity. This is where smart money wants price to go. This is where stops are resting. This is where the move is completed. Risk to reward is not based on hope. It is based on structure and liquidity. This is not prediction. This is alignment. And this is how you stop chasing trades and start understanding the story behind price. If this explanation helped you see the market more clearly, make sure you are subscribed. In the next video, we will go deeper into entries, confirmations, and execution precision so you'd apply this framework step by step. This is education, not a signal. Trade responsibly.